Hello, this is Woohyun from Learn to Share. Today we'll be learning about GDP and AD-AS model that is fundamental content from macroeconomics. We express gratitude to Letitu for corporations and sharing the resources. The lecture will be proceeded in the following order. To begin with, macroeconomics take a broader view on economy, including analysis with indicators, policies, and trade with foreign countries. The figure shows the circular flow in macroeconomics, with government and foreign market included as an economic subject. We should remember how each subject make consumption as circled. So household make consumption and government makes government expenditure, and firms have investment and we get that export from foreign market. And GDP, one of the basic measurements to evaluate production in a nation, is defined by a total money value added in an economy. And there are important conditions. It counts only finite goods and goods that have market value and produced within domestic boundaries for a certain period. It is mostly 1 year. And also pure transactions such as government expenditure for welfare and social services and second-hand sales like used goods are not included in GDP. For example, let's imagine making a car. The intermediate goods such as steels and factories to produce a car is not included, and only a complete new car is counted as a GDP. Also, chores, volunteering, and all activities that are not transacted in money also do not belong to GDP. The goods should be produced in a nation. Japan is teaching math in Korea belongs to GDP of Korea, and Korean teaching math in Japan belongs to GDP of Japan. So this was the concept of GDP. However, GDP has some clear limitations that not only it excludes no-market barriers, it cannot measure actual quality of life and leisure of citizens. There are important social measurements that also have to be considered, but GDP excludes them. Also, it cannot consider purchasing power among transit of diverse nations as the process of trade. And it also excludes negative externalities that will run in macroeconomics, such as polarization, inequality, environmental pollution, and climate crisis, which creates additional social costs. Therefore, alternatives such as GDP per capita, which is GDP divided by the number of population, and HDI, Human Development Index made by UN, and green GDP is utilized. There are 3 main methods to calculate GDP. First, output approach is accumulating the old productions by summing price multiplied by quantity of each good. Second, income approach is the sum of factor income, depreciation, and tax. W multiplied by L is income from labor, and R multiplied by K is income coming from capital, and pi means the first profit, and this mark is depreciation, which is fixed capital. Also, we have to add indirect tax. So there's our income approach. First, this is expenditure approach, and this is very important that you have to remember. It can be calculated by C, consumption, plus I, investment, plus G, government spending, plus NX, that export. That export means export minus import. So how lots of money the country earned from trade activities, right? And investment also includes the purchase of assets such as real estate or land. So the questions do not ask you to directly calculate by using those equations, but that are important because the question asks how you should approach to calculate GDPs. Nominal GDP is calculated based on the current year. For example, let's hold an example of this year. However, real GDP is based on the certain base year. There is a certain base year to estimate GDP to fully reflect the change in price level. This is really important. So real GDP is calculating this year's GDP based on the GDP of 2020. In Korea, it takes methods of changing base year by 5 years term. So current year's GDP will be calculated by 2020 GDP. So we can notify the change in price by using GDP Deflator, which is nominal GDP divided by the value of real GDP and multiplied 100. For example, if the value is 110, it means price increased by 10%. And this is frequently asked in AP FRQ questions. This chart organizes similar indicators with GDP, and this is not frequently asked in AP exams, but you can see terms like GNI, NI, DPI easily in economic sessions. So we recommend you to comprehend of this. So I have organized what belongs to them and what does not belong to them. Let's move to business cycle. Imagine a child. He would be sometimes sleek, but sometimes too active as well. Economy is same as a child. When it expands inflation and it reaches the peak. However, the economy is often sleek. It goes down to recession and it reaches the through. So this average line of the graph of business cycle is defined as potential GDP that a nation is expected to achieve in the long run. Macroeconomic policies aim to achieve a full employment and price stabilization in short term, and this is mainly done by adjusting the demand. However, in the long term, it aims to increase the potential GDP itself by changing the slope. So it is done by adjusting the supply, and it requires the long term. So this is one of the key points of today's lecture. In macroeconomics, we use a new model, aggregate demand and aggregate supply. It is similar to normal demand and supply curve that you're familiar with in macroeconomics. However, it is total sum that is produced in whole economy. So we always take macroeconomic perspectives. Aggregate also means the total sum. And from now on, I will say aggregate demand as AD, and it indicates the total demand in an economy. AD equals to C plus I plus G plus NF. This is just export minus import. So this is same as GDP calculated by expenditure approach. And real GDP increases and the price level decreases. There is a reverse relationship. Then let's find out why it happens. We can explain it by three main effects. Let's assume the price level reduced. First one is worth effect. So decreasing price make you feel you have more assets, and it increases the value of assets. So it will encourage greater consumption. Just because you can afford more things to buy when price decreases. Second one is interest rate effect. Lower price reduces the value of money, therefore reducing the interest rate and increasing the purchasing power. And lower interest rates alleviates the debt burden of companies, so it promotes greater investments, so it will enlarge the I. Remember that the equation was C plus I plus G plus NS. So by wealth effect, C increased, and by interest rate effect, I increased. Also, the last one is trade effect. It will make our nation's goods more cheaper, and it will promote more exports, and while imports reduces. Therefore, we earn more profit from trade activities, and therefore, NS also increases. So NS has also increased. Then someone may question why G is not changing. But G is not changing because government can actually change it by their own policies, and we will cover at the next lecture as the name of fiscal policy. So we will move on to the next. And there are some factors that shift the AD curve. Change in wealth, economic policies of government, like fiscal policies and monetary policies, confidence on economic predictions, and improvement in trade terms all may shift the AD curve to left or right. If the situation improves or gets more positive, then you may think the curve will shift right. Then let's look at AD-AS model, aggregate supply. So it is total supply in an economy, and our GDP rises when price level increases. However, this is not in exact shape, and we will analyze it more specifically later. We will first learn how this relationship is established in the priority. The equation indicates the profit making of firms. Profit is total revenue minus total cost, which means P multiplied by production minus all cost for labor and capital. So this is revenue and this is cost. Y alpha K is production function and macroeconomics. And in short run, increasing price only changes P, as P increases, and therefore profit will also increase. The company can afford more L&K employees to make profits, therefore AD increases because it creates more and more goods and services. There are some factors that can shift the AS curve. Indirect tax, increase in production cost, shift to left, while increasing resources and advance in technology shift it right. So those are all important factors. We now must look at the shape of AS curve. It is not simply upward sloping. It remains horizontal at first, and it gradually increases, and it finally becomes vertical in the long run. So we can divide it into three main stages. The journey of A to B in short run as Keynesian range, and price level is horizontal because nominal wage does not follow the increase of price level. So there is always gap with nominal wage and price level increase. So we call this sticky wage effect. And this was claimed by Keynesian economists after Great Depression. But in C, in this classical zone, the wage rapidly follows the increase of price level, and it becomes vertical. It is not changing. And like the point C corresponds with potential GDP. Therefore, we can actually see mirrored S shape, like this shape, this shape maybe, right? The equilibrium of GDP happens where AD and AS curve intersect. Let's redraw the graph. So this is AD, and this one is short run AS, and this is long run AS. So if the equilibrium is smaller than long run AS, then the economy is in recession, and this amount is recessionary gap. However, if the equilibrium is greater than long run AS, then it is in inflationary gap. The economy is expanding, and therefore inflationary gap happens. So you should be reminded of these two terms. We'll talk about this deeper at the next lecture. So this is the end of today's prepared lecture, and thank you so much for listening. And also thanks to Letitu for sharing resources again. Please subscribe and press like to our channel. See you next time. Goodbye.